back to the mortgage reports. Today, we're answering one of the most common questions from homeowners thinking about a home equity line of credit. Do I need an appraisal, and what exactly does that look like? Now, if you're planning to tap into your home equity with a HELOC, understanding how lenders value your home can make a big difference in how quickly your loan closes, how much you're approved for, and even how much it ultimately costs you. Now, in this video, we'll walk you through everything from why appraisals are used, how they work, the types you might encounter, costs and timing, and even what happens if your home appraises lower than expected. Now, by the end, you'll know exactly what to expect and how to prepare for your HELOC appraisal in 2026 and beyond. Question 1. What is a HELOC appraisal, and why do lenders require one? Okay, so a HELOC appraisal is a professional valuation of your home that shows the lender how much your property is worth in today's market. It's a critical step because the amount you can borrow with a HELOC is tied directly to your home's appraised value and your existing mortgage balance. Lenders use this valuation to calculate your loan-to-value ratio, usually expressed as a percentage, to ensure that there's enough equity to back the credit line they're offering. Now, if your home is worth less than expected or market values in your area have shifted, that can directly affect how much you're able to borrow. So the appraisal isn't just a formality. It protects both you and the lender by providing an independent third-party assessment of your home's value. Question 2. How does the appraisal process work for a HELOC? Well, there are a few different ways your home can be appraised. And which one your lender chooses depends on everything from local market conditions to how big your credit line request is. The most traditional method is a full in-person appraisal. Now, in this scenario, a licensed appraiser visits your property, walks through the interior and exterior, notes its condition, updates, and special features, and then compares your home to recent sales of similar homes nearby. That report becomes the official valuation. Now, in recent years, lenders have also started using less intensive methods in certain cases, such as drive-by appraisals, where the appraiser only inspects the exterior, and desktop appraisals, which rely on public records, tax data, and recent sales without any physical inspection at all. Now, additionally, hybrid appraisals mix remote data with limited on-site information. In some markets, lenders may even accept automated valuation models, or AVMs, which use algorithms to estimate value based on large data sets. Each method has pros and cons. Full appraisals tend to be the most accurate, but also the slowest and most expensive, while automated methods are fast and cheap, but not always precise. Question 3. How long does an appraisal take, and how much does it cost? Now, if you're getting a traditional in-person appraisal, plan for the process that can take anywhere from 1 to 3 weeks. From scheduling the inspection to the final report delivery, that's the time frame it could take. On the other hand, desktop or automated valuations can be completed in a matter of days or even hours, which can help speed up your HELOC approval significantly. Costs vary as well, so a standard in-person appraisal typically runs anywhere from $350 to $500 or more, depending on your location and the complexity of your home. Drive-by and desktop appraisals usually cost less, sometimes between $75 and $200, because they take less time and effort from the appraiser. Now, keep in mind that if you want to pay for a more detailed appraisal for yourself, you can always request that. Question 4. Can you get a HELOC without an appraisal? So, yes, in select situations. Now, some lenders may waive the appraisal if you have a fairly recent home valuation on record, such as a purchase appraisal from a certain time frame, usually a few months. Others may rely on newer automated tools or internal valuation models instead of ordering a full appraisal. That said, these no appraisal options are not guaranteed and typically work best for borrowers with strong credit, a conservative loan amount request, or a high percentage of home equity already built up. Every lender's policy is different, so it's important to ask upfront about their specific requirements. A no appraisal HELOC can save you money and speed things up, but it depends heavily on the current market data and the lender's comfort level with automated or desktop valuations. Question 5. What happens if your home appraises lower than expected? Well, when a home appraisal comes in lower than anticipated, it can affect a HELOC in a couple of meaningful ways. First, it may reduce the total amount of equity the lender is willing to let you borrow against, because your available borrowing power is calculated as a percentage of the appraised value minus your existing mortgage balance. A lower valuation means less equity, which can translate to a smaller HELOC limit. Second, a low appraisal might prompt you to rethink your borrowing strategy. You may choose to borrow less, look at other financing options, or increase your equity position before applying again. Some lenders allow you to request a reconsideration of value or a second appraisal if you believe that the initial valuation missed key improvements or comparable sales. But policies vary, so always check with your lender first. Next question. How can homeowners prepare for a smoother appraisal? Preparation is one of the smartest things you can do before an appraisal. Simple home upkeep, like repairing obvious issues, ensuring walkways and landscaping are neat, and making sure interior spaces are accessible and presentable, can help the appraiser understand the care you've invested in your home. Now, documenting recent updates, such as kitchen or bathroom renovations, new flooring, or updated systems like HVAC, can also be helpful. Make sure you have receipts, permits, or a list of improvements ready to share if the appraiser asks. While appraisers follow strict professional standards, giving them clear, organized information helps ensure nothing valuable about your home is overlooked. Being informed and proactive often leads to a more accurate valuation. So, final thoughts. Appraisal requirements for HELOCs may seem complicated at first, but once you understand the purpose and the process, you can approach them with confidence. Whether you're looking at a traditional in-person appraisal or hoping for a faster automated valuation, knowing the options helps you plan your timeline and budget. Preparing your home, understanding how your equity is calculated, and being ready to discuss recent improvements can go a long way toward a smooth experience. And if an appraisal comes in lower than expected, don't panic. There are steps you can take, and your lender can explain alternatives or next steps. If you want the full breakdown of HELOC appraisal requirements, costs, timing, waiver options, and valuation types, check out the full article from the Mortgage Reports linked in the description below. And if this video helped make HELOC appraisals clearer, give it a thumbs up, subscribe for more home finance insights, and drop your questions in the comments. We'll cover them in future videos. Thanks for watching, and we'll see you in the next one.